Don't you hate when you hit the wrong theme music? Yep, I did. But welcome to our weekly look at the markets on a Sunday evening. Welcome to our top tier outlook live. We're going to take a look at, of course, what's going on at the very earliest part of the week, the Sunday open. And we're going to take a look at your questions, of course, on the economic calendar, which is if we thought last week's Jackson Hole was, wow, we're going to get a little bit of a break after all the hot suns last week, waiting to hear from Jerome Powell. Uh, Clearly, this week might be a little bit smoother sailing. Negative, Ghost Rider. We're going to be kicking off the last trading week of August. We're going to be kicking off non-farm payroll this Friday, September 1. And it shan't be dull because with as sort of non-committal as Powell was in his very brief comment, I think he hit the mic at 3 minutes after 10 Eastern. He was gone by 18 minutes after the hour, 15 minutes, not much new. But we're going to talk about what adjustments were made in that very brief commentary. And I really do want to dive into a couple of things that are going to map to the game plan, not just for the end of August, but for September and likely into the end of the year. I'm not saying where we're heading into the end of the year, but what I am saying is the terrain that we pretty much are surrounded by is going to be bumpy. And I'll explain why and what the antidote for that, what the action we can take for that will be. So let's go ahead and jump into what we've got going on in our broader averages. So one of the things we talked about in the top tier outlook issue of last week, so that would have been the August 21 issue, August 28 issue should be out before lunchtime tomorrow, usually before the open. But last week, we talked about a retracement in the NASDAQ, in the S&P to, as we endearingly call it, the Pingala in the Sector Secrets Mastery. And that's the 50% retracement. That is the look at the last major move. And if we were to retrace half of that, the 50%, where would that land us? So that was pretty much nailed on the NAS, really close on the S&P. And what do we expect at that 50% point? Well, it's no different on a daily than it would be on a weekly versus a 5-minute time frame. And that is, it's simply resistance. And at that point, buyers really have to fight their way through, say, 15.4 in the NASDAQ, and probably even more challenging number overhead for the S&P traders, which is 4,500. The more zeros there are in the number, the more difficult it's going to be typically to break it. So 10 versus 100 versus 1,000 versus 10,000. The more zeros, the more formidable the level. It's just a major psychological level. And that's what we dealt with last week. And we were quickly set lower. But keep this in mind, gang. This is where we want to ask ourselves, are we going anywhere new? Now, if you're a weekly time frame trader, are we going anywhere new as opposed to the weekly ranges that preceded the current weekly candle? On the daily chart, this daily time frame, I asked myself, are we going anywhere new? Not relative to the previous session, but in relation to the high low that's been established on the daily time frame. We have yet to really go anywhere new. We have to break 45.20 to go somewhere new. We have to break 43.50. So to the upside, we've got to break. Let me show you again. There we go. To really go anywhere new, we need to break above 45.20. To go anywhere new in the S&P, we need to break below 43.50. Anywhere inside that is akin to going over a well-worn path. Now, if the question is, are we going anywhere new in relation to yesterday? That is a day trading question, right? That's a question about how can I use the previous session's close as a tool, as a way to measure what I'm going to be dealing with in the current session. And so with that in mind, gang, and I'm going to explain why I'm having a conversation, a breakdown of how I'm day trading. I'm going to show you how I've been doing in August. And I want to mention August specifically because I'm going to be totally frank. I slayed July. A lot of us did, right? I'm not in any way celebrating. There's no confetti falling from the ceiling here in this office. Most traders did really well in July. It's a seasonally bullish month. And so, yay, everyone who was able to follow the trend did pretty darn well in a pretty easy month. But to think that August would be like July would be to ignore the seasonal fact and the macroeconomic fact that July was a mirage. July was a break, right? It is not going to be the way August behaves. Clearly, we're practically done with August and it doesn't look anything like July. The question is, when could we see action like July again, right? Or even better, the question is, what do we do until the market starts finding support and moving higher? By the way, answer to the first question, not until at least the November meeting. That means the remainder of August, September, and October are likely to be needing some Dramamine, fairly seasick, nausea-inducing. That's okay, as long as we're not thinking that the follow-through is going to be like July. So if you haven't seen it already, simplertrading.com/consistent, August 30th. That's on Wednesday, 8 p.m. Am I going to be talking about an upcoming class? Yes. I'm going to be talking about how I'm day trading right now and how I'm going to be day trading probably until maybe the first rate cut. So that could be not only now till November, that could take me now to the end of the year. This could take me now to the end of Q1. Whenever we can say the macroeconomic confusion, or as I said in the Friday video, the macroeconomic murkiness has lifted. And that really won't be official until we get that first rate cut, right? We're still waiting on the pause, then we'll have the cut. So all we want to make sure is that we're keeping our pipeline full of opportunity. So let's talk about this daily time frame some more. The reason it's so important to start with that daily, and I'll get into a lot more examples on Wednesday, as well as my current August trading, specific to day trading options on stocks and ETFs. The reason August hasn't been bad is because we knew July was going to be really kind to swings, which it was. I think our swing trades were every bit as good as our day trades, if not maybe better. But in this month, my day trades have outperformed my swings, not only in their rate of occurrence, but their actual return. Because this is the environment where it's tough to get session after session after session of follow through. That was easy in July. So if we shorten our time frame, the window that we need for follow through is smaller. So day trading is not about hyperactivity and 27 round trips. Day trading is simply, can I shorten the time frame, reduce my exposure to the market, and not require the day and the day and the day after follow through in the direction of my trade? Because that's really not happening. I mean, take a look. How many traders on the S&P just said, all right, look at all this great momentum August 23rd, and then got absolutely slam dunked, right, on the 24th? Or on the 24th said, all right, let's get short. This market's toast. And they got absolutely face ripped, right? That's a face ripper move. I don't know why they call it that. It's just a terrible term, but that's just what they call it, right? Just ripped higher. So this is what I mean. Just when we think, oh, we're getting this bullish momentum, let's go. Let's go. We're getting this bearish momentum. So what does CHOP do? CHOP is terrible to bulls and bears, to buyers and sellers, unless they shorten the time frame. So in the morning, take note of where we are on that daily. It's going to make a big difference. So when I'm doing that now on the Dow, and I'm looking at the action here as we start this is really the candle for the 28th. So as I look at this, I think, all right, this is a bullish start. This is actually a bullish start to the week. We'll see where we are tomorrow at 7 Eastern. We'll see where we open tomorrow at 9:30. We'll see where we are after the opening range or clearing period at 10 a.m. But right now, this is a bullish open, right? So I'll say, all right, we're trading in an area that represents, not because the markets are simply going up, but from where they're going up from. That's the key again. It's simply not momentum, but where from, right? Where is that momentum coming from? All right. So next up is our look at the bonds, right? So we take a look at the bond market. What we want to remember is that this market, gold and the euro, are really at the very center of the what are they going to do conversation. That could be the FOMC, but also the ECB as well. If bond traders truly believe that the FOMC is less likely to hike more than one more quarter point or not at all, bond yields should go down, which is to say the ZB futures, ZN futures, the TLT ETF alternative, the IEF ETF alternative should start moving higher. We're not quite getting that yet, but I think it's worth mentioning that when we look at the daily time frame, we're not down at the lows anymore. Those lows were established on the 22nd of August. And if I ask myself, well, what do the buyers need to do to really prove they're at, kind of at the helm? They've got to close consistently above the 120 handle before anybody believes buyers are truly willing to step in near-term highs. In other words, a near-term high is established and buyers are willing to step in there. It's not really about necessarily stepping in at 117.20, 117.18, although that would be expected and great. At this point, to break the downtrend, buyers have to be willing to buy near-term highs or even above them, right? Because part of an uptrend is willingness for certain groups of traders to buy new highs, and then to buy new highs again. And that's someone's behind them. If I buy at 9, someone's going to be behind me willing to buy at 9.1, and someone's going to be willing to buy behind them at 9.2, and so forth. That's how trends are made. Someone's got to be willing to pay up, right? And so if that can happen, doing that above, say, 120, even above 120.10, actually 120.20, above the August 24 high. Take a look. Above that August 24 high, which happens to be a Darvis level, that would be very, very important. All right, so those are some of the key looks at indices and treasuries. Last thing we'll look at here before we jump into the questions. As always, feel free to type them in. The next thing is going to be, what's the story with the 6E? We always want confirmation that a particular low has two things that it doesn't have to worry about. One, an economic significant event, a hot zone. Jackson Hole was it last week. So even though we went down and tested the 200 on the 23rd, really didn't matter until we heard from Jerome, right? It really didn't matter until Powell spoke. So price could reach certain levels, but until price reaches certain levels and a particular hot zone, a high impact event has happened, we don't want to step in front of that, because the uncertainty around a central bank, head of a central bank speaking is far more important than the fact that, price reached another price-based indicator. So please keep that in mind. However, if we can get back above around the 108 area, that would be significant. But for right now, the euro remains oversold. But by the way, it has been for almost 2 weeks. So let's remember, of all the things that we could look for an edge in, I don't know the euro's near the top of the list. If I'm looking for edges, I'm going to look for relative outperformers. And even more so, I'm going to look for relative outperformers on an intraday basis. So I'm going to show you all another chart or another image here. And again, why are we talking about day trading on Wednesday? Because the kind of action we're seeing right now is going to mandate that we shorten time frames. That's what's working. That's what I'm going to show you in depth on Wednesday. So let me show you why this is happening. So a lot of folks might say, okay, Rag, but why would we be concerned? Is it just your opinion? Well, I try to think about trading what I see, not what I think. And that means I'm not going to say, oh, the markets are too high, too low, they're due for a correction. That's nonsense. All of those things are nonsense. Why? Because I don't know what's going to happen tomorrow, and neither does anybody else. Forget 3 months from now or 3 weeks from now or even 3 days from now. I do know there are going to be certain events, and I do know there's certain opinions, right? The market works based on what's the current opinion, largest held, and then what events could either accelerate that opinion or even reverse it. Take a look at the November 1st target rate probability. For the first time ever for this contract, this is a futures contract, by the way, we're neck and neck with a pause, which is on the left, and a hike, which is in the center. We're neck and neck. Talk about confusion. We are equally thinking, it's a flip a coin scenario. We are equally thinking the Federal Reserve could pause or could hike in November. Big reason why the short-term timeframes are working. We don't know what's going to happen next. In an environment where you don't know what's going to happen next, are you going to think 2 and 3 weeks and months and 2 or 3 years down the road? Or are you thinking in a very short-term basis because of the uncertainty, right? Okay. Then it's kind of like driving in fog, right? I just can't see. So we're going to take it slow. We don't trust. We're cautious. We're scared. If you look at December, it's the same thing. It's neck and neck. Now, I'll tell you let me take you back on over there. I will tell you this, the hike is a smidge higher, not much, than the pause. So there's a little bit more hawkishness that came into these Fed fund futures after the Jackson Hole Symposium. So if someone says, well, Powell didn't say anything, but there was a reaction, right? So he doesn't have to say something massive to move the market in a way that everyone sees, right? A lot of folks aren't going to look at what you're looking at right now. Most folks aren't going to look at that at all. They just want to know if tech's moving higher or lower. I mean, realize most market participants, most retail, your average retail trader, and if you're watching me on a Sunday, you are anything but an average retail trader. But you know what your average retail trader is wondering? What's going to happen next with Tesla, with the NASDAQ, with tech, with NVIDIA? No, gang, it's a great big market out there. And part of why anything's going to move is based on target rate probabilities. So most traders are completely unaware of these. And so now you know. By the way, if you ever want to look at this on your own, just Google CME FedWatch tool. And you can look at this decoder ring. This is the magic decoder ring for the Federal Reserve. All right. What's the other reason short term is going to be so important? I'm going to show you the other reason right now, and that's a seasonal reason. This is the S&P over the last 5 years. So I've been saying this a while. July was an easy month. Most of us did pretty well in July. If you didn't do well in July, think about some of the things I teach in Charts and Coffee, and think about what we do in the Top Tier Outlook and even in the Sector Secrets Mastery. July was a very good month. Why? It was largely a bullish month. So if I say, well, this is how well I did in July, now let's go to August, it almost means nothing, because the types of strategies and the expectation for follow through and even the time frames that we could have used in July are almost not even applicable to August. So be careful when someone says, well, this is what I did last month. That was last month. What does this month present? And what actually, if anything, goes from month to month. So yeah, like I said, it was great to have one of those gift of a month like July. Moved up, very bullish. Everything seemed to rally. It was just easy to buy the dips and get followed through for days and days on end. That was a function of July. By the way, if you're following seasonals, you knew, there's a tendency for the market to behave this way. Just as there's a tendency for the market to be choppy in August. The chop in August and my retreating to more of a day trading approach has everything to do with, one, this is what we're likely to see. And then we started seeing price action reflect the seasonal type of tendency. So we make the adjustments. Take a look at September. Whoa. Take a look at October. October looks a lot like August. So like I say, we may not see something July-esque until November. So what do? Keep buying the dip? Only if you hate your money. So what we want to do is make sure that through August, September, and October, we have this gear to shift into. And frankly, even if November is a great July type rally again, look at what we get in December. Or even look at what we get from mid-November to mid-December. So we're going to be right back into that choppy stuff. This is what I mean about making those adjustments. So between the macroeconomic murkiness and the reality about 5 years of seasonal trends on the S&P, this is very likely the scenario. But if we want to keep our pipeline full of opportunity, we just have to adjust our timeframes and adjust our strategy to enter trades in such a way we don't need day after day after day of follow through, but rather maybe 20, 30, 40, an hour, maybe 2 hours of follow through, and then we can look for another setup after one trade follows its cycle, but it's a shorter intraday cycle. So I hope that makes sense, gang. So that's what I have for you all for our Top Tier Outlook today. I will see you all on Wednesday. If nothing else, you're going to see what my AM, PM strategies are, how the daily time frame plays a big role, why consistency is everything. I'm going to talk about how I pick strikes and expiration. That's always been a big question, so I'm going to get into that as well. I'm actually looking at the slide deck. We got a lot of things that I'm going to be sharing with you all. How we use volatility and how structure dictates strategy. A lot of cool stuff. So I'll see you then. In the meanwhile, enjoy the rest of your weekend. I'll catch you tomorrow for Charts and Coffee. Be good to each other, gang.